The Walt Disney Company is a global media and entertainment conglomerate that owns some of the most loved brands and franchises in the world. As investors, we have to look beyond the mouse ears and lightsabers on the surface to find out whether or not Disney stock is a good investment. In the previous video, we went over Disney's business segments, financials, economic moat, and management team. I highly recommend watching that video if you want some context on Disney's business. Now we'll go over some key ratios, growth, and calculate the intrinsic value and buy price of Disney stock. Now we'll look at some key ratios of the Walt Disney Company over the past 10 years. Here's a graph of the debt-to-equity ratio over the years. As you can see, since 2011, it's been consistently below 1, even with the new debt they've had to take on due to the 21st Century Fox acquisition and the pandemic. This shows that Disney's management team has been keeping the debt at a reasonable level and were prepared for a black swan event like the pandemic. The next ratio is the return on invested capital, or ROIC for short. Here's a graph of the ROIC over the past 10 years. As you can see, prior to the major acquisition in 2019 and the pandemic in 2020, Disney had been consistently increasing their ROIC over the decade. For comparison, competitors in the media and entertainment industry have consistently had an ROIC below 8% over the past 10 years. This metric shows that Disney's management team was skillful at allocating capital for the business. However, this was former CEO Bob Iger at work, and not current CEO Bob Chapek. Disney usually has a current ratio of less than 1, since deferred revenue is a big part of their business. However, in the 2020 annual report, Disney's current ratio was 1.32. It seems like they're trying to show shareholders that they're more than prepared to repay their current liabilities within the year. Now we'll take a look at Disney's earnings per share growth over the years. The earnings per share have increased almost 13% per year over the past 10 years. Even though earnings per share increased 13% per year, net income didn't increase quite as much. This is because Disney bought back their stock and therefore lowered the shares outstanding. This made the earnings per share increase more than the net income itself. It's also important to look at Disney's margins to see how their economic moat helps them more than the competition. Here are Disney's operating margins and net margins over the past 10 years. As you can see, they were consistently increasing before 2019, which again shows that Disney was increasing revenues while keeping costs more or less stable. Think about it. Avengers Endgame didn't really cost that much more than the first Avengers movie, but the box office sales were almost double the sales of the original Avengers movie. This creates higher operating and net margins, which is great for shareholders. Competitors in the industry have lower operating and net margins than Disney. The competition averaged about a 17% operating margin and an 11% net margin. Disney has cut their dividend since the start of the pandemic and will probably not pay a dividend for a long time. According to Disney, this is so that they can easily repay their debt and fund new content on the direct-to-consumer subscription services. I actually think this was a really good move for Disney, since they've decided to control debt and focus on growth. So now that we've seen how Disney has done in the past, let's look to the future to see how the Walt Disney Company will grow in the next decade. First and foremost, Disney knows they hit the jackpot with Disney Plus. They have already exceeded their expected subscriber count for 2024 in 2020. So, Disney is shifting a large part of their resources to focus on the rapidly growing direct-to-consumer services. For instance, Disney is reorganizing the business segments. Instead of having media networks, studio entertainment, and the strange direct-to-consumer and international segment, they will have 4 segments named Studios, General Entertainment, Sports, and Distribution. The Parks, Experiences, and Products segment will not change. As far as the direct-to-consumer growth, Disney has raised their expectations for the 2024 subscriber count to between 230 and 260 million subscribers on Disney Plus around the world. They have also raised their expectations to between 300 million and 350 million subscribers on all services combined. They've projected about a 25% to 35% growth rate over the next 3 years, and the streaming industry as a whole is expected to grow 15 to 20% in the next decade. With these numbers in mind, Disney's direct-to-consumer streaming services are expected to grow between 17 and 23% per year over the next decade. The media network segment has historically grown 6% per year over the past decade. We can expect a similar growth rate of 4 to 7% per year over the next decade due to increasing content needed for subscription services in domestic and international markets. Even though cable and TV advertising is slowly declining, Disney is not a physical cable provider, and they have found ways for new advertising services through the subscription platforms. Disney's studio segment has grown about 6% per year over the past 10 years, and it's expected to continue to grow about 5 to 9% per year in the next decade. This is due to the increased content produced for Disney Plus and expanding content from franchises like Marvel, Lucasfilm, and 21st Century Fox. It's unknown how theatrical distribution will change in a post-pandemic world, but Disney seems prepared to adapt by distributing major blockbusters through the subscription services if customers don't return to theaters like before. The Parks, Experiences, and Products division has grown about 6% per year in the past 10 years without considering the dramatic drop in revenues and profits in 2020. Disney has chosen a different growth model for this segment in the next decade. The theme park and experiences sales are expected to remain relatively the same over the next 10 years, but guests are expected to spend more while on their vacations. Disney is basically shifting demographics to cater to upper middle or upper class customers who are expected to spend more on theme park admissions, hotel stays, and Disney products. Considering that we don't know when the pandemic will end, the growth in this segment is definitely the most uncertain. Disney expects theme park attendance to return to 2019 highs in 2021 or 2022. It's also expected that guests will spend 5 to 8% more per year, even without increasing regular theme park attendance. So, assuming the Parks, Experiences, and Products division returns to the 2019 levels in 2022, the growth rate for the next decade will likely be 5 to 8% per year. Now, to estimate the growth rate of the Walt Disney Company as a whole over the next 10 years, we can weight the growth rates from each segment depending on each segment's percentage of total company revenue for a normal year like 2019. We'll include the revenue of direct-to-consumer subscription services from 2020 as a percentage of total revenue since Disney Plus started creating revenue in 2020. Each segment's percentage of total revenue is 33% from media networks, 36% from parks, experiences, and products, 12% from studio entertainment, and 19% from direct-to-consumer and international. So if we weight the growth rates of each segment accordingly, we can estimate a growth rate of somewhere between 8 to 14% per year for the Walt Disney Company over the next 10 years. Now that we have the growth rates, we can attempt to calculate the stock's intrinsic value and buy price. We'll be performing a discounted cash flow analysis, so we need to find out the owner's earnings of Disney. Disney spends at least half of the capital expenditures from the cash flow statement on growth and new additions. Less than half of the capital expenditures are spent on maintaining the existing assets. So, the owner's earnings in Disney's case are the operating cash flow minus 50% of the capital expenditures. Since 2020 and 2019 were strange years for Disney that were abnormally low in owner's earnings, we can take an average of the owner's earnings for the past 5 years. This way, the starting cash flow will account for the fact that Disney is likely to return to higher owner's earnings in the next couple of years. The average of the operating cash flow over the past 5 years was $10,675 million. The average of the capital expenditures over the past 5 years was $4,351 million. Again, Disney only spent around half of this amount maintaining the existing assets, so the rest is considered part of the owner's earnings. Half of $4,351 million is $2,176 million. The adjusted owner's earnings in 2020 for Disney are $10,675 million minus $2,176 million, which is $8.5 billion. Now that we have the starting owner's earnings for Disney, we can find the intrinsic value. The discount rate for the intrinsic value will be what the investors in the stock market are currently demanding. Since risk-free rates like U.S. Treasury bills are around 1% and high-yield junk bonds are around 4 to 5%, we can assume the market currently demands around a 4 to 7% yield for stocks on the U.S. stock market. Since Disney has been greatly affected by the pandemic, we can assume the market demands 6% due to increased risk. So, the discount rate for Disney's intrinsic value is 6%. Using the worst case and best case scenario growth rates of 8 and 14%, as discussed before, we can calculate Disney's intrinsic value as somewhere between $255 and $406 billion for the entire business. This is the market capitalization, so the intrinsic value per share, assuming that there is 1.8 billion shares outstanding, is somewhere between $142 and $225 per share. This is the intrinsic value of the stock, not the buy price. The buy price should be a margin of safety to the intrinsic value to account for errors in the valuation. I wouldn't buy anything without at least a 50% margin of safety from intrinsic value. So instead of using a discount rate of 6%, we would use a discount rate of at least 12%. For Disney's case, I would use at least a 15% discount rate for calculating the buy price, since I personally target at least a 15% return. When we discount the same owner's earnings of $8.5 billion and the same growth rates at a 15% discount rate, we get a buy price of somewhere between $87 and $126 billion for the entire business, or $48 and $70 per share. The current market cap of Disney as of January 2021 is $320 billion, or $178 per share. From this analysis, it seems Disney is priced at or about intrinsic value. In fact, using the numbers in this analysis, Disney is currently priced at intrinsic value, assuming an 11% growth rate of owners' earnings over the next decade. But remember, intrinsic value isn't buy price. We must allow for errors in calculation to be sure to protect our principal as investors. Overall, I don't think Disney stock is a good risk-reward situation at the current prices. I will be waiting to see if the stock drops below $70 per share, and then I'll consider an investment. The business is arguably riskier than it has been in the past decade due to the unknown effects of the pandemic in the future. However, since Disney has subscription services that are in a high-growth industry, it's possible the stock could have a big potential upside in the next decade. It's also very unlikely that Disney would go bankrupt unless the pandemic dramatically alters consumer travel behaviors and spending habits permanently. To me, the potential upside already currently seems priced into the stock. Based on this analysis, the only thing an investor should reasonably expect at these prices is an average market return in the next decade. I hope this was helpful. Please leave a like and subscribe if you enjoyed. What stock analysis do you want to see? Leave a comment down below, and I'll see you again next time.